can't continue to go longer. I'm still bullish in the markets. I thought we can kind of kick off today with a bit of a top-down outlook and see like where are you looking at big picture for the markets? What do you see right now, and kind of front and center where we're at? Government shutdown. Are we going to have any data this week that matters? Does the market even care? You talk a gamma quite a bit, like I do. Positive gamma environment. I want to spend some time breaking that down. So I know that's a ton of questions up front, but first and foremost, kind of top down, like, is this the everything bubble? Just asking you. Asking for a friend.
Well, it's hard to say it's not just because everything is up, like you indicated, even all the major indices are up. It is rare for us to see absolutely everything up.
Yes.
Normally when we say, okay, when you get big market crashes, you get extreme correlation. Everything goes like COVID, everything went down at the same time.
Right.
It is not often, I don't even remember a time during my trading career where everything went up all at the same time. So we are kind of in like this very rare territory, and it could indicate that there are shifting changes, that actually something might be fundamentally shifting in the markets.
Right.
And what I mean by that is what I'm looking at in particular is the importance of treasuries and treasury rates. So I think the one thing that is starting to buckle and starting to buck the trend is those treasuries. Yeah, they've been kind of flat, right?
Yep.
So and then I guess up a little today. I haven't been watching today, but it looked like it was turning down. If you look short term, like if you go from June-ish or mid-May down to now, and you just connect those highs, that is a downward slope. And actually, if you go at the beginning of 2025 all the way till now, that is a downward slope connecting those highs.
Yeah.
So that has me a little bit concerned because generally, if your treasuries are not doing well, then you're looking for higher yield that in treasury stocks, and that's not generally super healthy for markets. So that's the first sign of weakness that I'm seeing right there, and that's sort of bucking that trend.
Okay. Is the market just better at these faster cycles? Because I think right now, so I listened to some interesting sessions this weekend, and just kind of on the macro side, and I tend to put in all my content that I read and listen to, like podcast wise, and it's kind of it's a full circle. It's like I've got some macro bulls, macro bears. I just want to kind of keep my head on a swivel to make sure that I'm not going to be blindsided by something. And I think this year, you and I have talked a lot about this. We've seen this for the last couple of months, especially. But the sentiment reports, the AAII sentiment reports, have continued to stay pretty bearish on the bearish side. And yet, and for the last couple of months, especially, I've been a very passive participant in this melt up. Even last week, we printed on October 1st, and we still are sitting around 40% bearish. The big jump that I saw in the sentiment survey was this big move from 28% bullish up to 41. And now you can see that the bulls have stepped back in. But really what this is peeling off a bit off the bearish camp, but a big jump off the neutral camp. So I think about this, 5% off a neutral. And now we're like, look, if you can't beat them, join them. We got to go bullish because the market's at all-time highs. And the bears are still persistently high. And I just think that until this is either extremely bullish and the bears just throw in the towel, I think this market just has been sniffing out the pain trade as we're going to go higher because everybody thinks there's a recession. Everybody thinks it's going to be bearish. Everybody thinks this is the debt bubble, the everything bubble. And the scary part is nobody knows how long that runs. Like, this will be a bubble after we already see like a 10, 15, 20% correction that maybe becomes the corrections that will look something like this, where we have, whenever the market decides to roll over, we have like a 10% correction. And then the market goes down for another 10 to 15%. And then maybe it goes down one more time. Well, now everyone's going to say, well, see, we told you it was a bubble. But you don't really know that until it's already here, right? Or it's already here. Then you can say, well, that was a bubble. But it'd be months in the making. So anyway, I think that's what I've been looking a lot of, is the sentiment is still persistently bearish. And I don't understand how this market is going to just give everyone the crash that they think is going to happen. Or at least when it does, it's when nobody is looking. So I just think the pain trade is bullish, and it's going to make everyone feel like crap, and it's going to make everyone feel like they missed out, they didn't participate enough, or all the funds that are underweight equities that just have to get back in and somehow participate, start scaling back in, dollar cost averaging, something to say, if you're a fund manager underperforming right now, you don't look very good. You know, I mean, I just think that if you're at single digit gains for the year, the only thing you might be able to pass off to your clients is that, well, hey, look, we only had a 5% drawdown during the Liberation Day drama. But if you're at single digit upside and the market all by itself is at 15, 16%, you've got individual stocks up triple digits this year. I feel like this is making, for the most part, the funds look pretty poor. Any thoughts on that as far as like sentiment? Do you think the pain trade is still to the upside?
Oh yeah, yeah, for sure. And then, like you said, it's probably going to catch most people off guard. And so the way that we deal with it in as retail traders is different than how fund managers have to deal with it. So as
Sure.
retail traders, you just basically you gotta have your basic rules and your basic idea of, in these market conditions, I am going to be net bullish. In these
Hmm.
market conditions, I'm going to be net bearish. And then if you want to, like if you're at the level where you're actually building like a long short portfolio, that's probably the best thing you can do as a retail trader. So that way you always have some natural hedges in
Sure.
place.
Speaking of it, I mean, if you're okay sharing some of this information, like how are you kind of positioned right now for all of this? Are you taking individual trades with just certain strategies where they're kind of like a binary result, I win or I lose? Do you have an allocation? Are you kind of percentage allocation guy? Like what do you kind of have building up to current levels?
Yeah, it depends on the account. So
Okay.
it's a mix. So certain accounts I have, they're just individual positions, and all I
Okay.
care about is each position and what it's doing.
Yep.
And the others are long short portfolios that are net bullish.
Okay.
That not I'm not at the point where I'm strongly bullish yet,
Yep.
and I'm definitely not crazy bullish or stupid bullish, but I am net bullish. I just it doesn't make sense to be neutral at the moment in
Right.
this market. Yeah.
Right. Um, can you share a little bit as far as percentages? Do you trade a lot of indexes? Do you have mostly individual stocks? Are you into certain assets?
Yeah, so indexes will always be my stable source of cash income, so income style. So I have a steady flow
Okay.
of income style trades that bring in cash on a regular basis, whether that's on a 1 week or a 1 month basis, depending on the account that I'm trading in.
Okay.
And then on top of that, it's built on individual positions or individual strategies. So I might have an
Okay.
account where I have, okay, this is my whatever, like my Maverick account, and then this
Yep.
is my
Yep.
Quantex account, and things like that.
Okay. And those are all based on what? So can you give an example of is a Maverick account index related or is it individual stocks? Both.
It's individual stocks. Yeah.
Individual stocks.
So
Okay. Got it.
yeah. So I'm looking. So basically, I separate my stuff by the edge that I get in the system that I'm trading.
Okay.
So if I have a pullback system, I'm not going to pile a whole bunch of pullback systems on top of each other, right?
Correct.
So
Yeah.
yeah, so it just depends on how it operates in the and what edge is it. So for example, Maverick and Quant X, they're looking for market maker future projections,
Okay.
and Gamma Pockets looks for market maker hedging activity. Those are different hedges, and
Gotcha.
they may disagree with each other at certain points in time,
Hmm.
which is okay. That's what I'm looking for. I don't want
Yeah.
complete
Well, a
agreement across all
disagreement
my
is
systems.
also like a built-in hedge, right? As long as you can come out ahead on if they kind of overlap, but they're kind of opposing views, as long as there's some asymmetry built into the trade, you can basically net positive. Is
Yeah,
that true?
exactly.
Yeah,
Yep. Yep.
which is good. Okay, I wanted to ask that because I just took I was reluctant to do it, but the last couple of weeks has really been hitting me pretty hard. Where basically I had going into this year, I was about 5% gold and 5% silver and 5% Bitcoin. Well, 5% gold has turned into almost 10, 11% gold, and 5% silver has turned into almost 13, 14% silver. So I decided that I've got to trim those positions back. But moving forward, I am going to have a slightly larger allocation. So I've drawn this out before, but my thoughts of going into 2026 is to kind of simplify my portfolio where if this is my pie chart, I'm probably looking at maybe a 50% equity split. And in there, probably, I'm going to say, I said 40 in the past, but that's probably conservative. I'd say 40% will be based in gold, silver, commodities. 10% will be Bitcoin. and 50% will be equities. Now, the nice thing is all of this adds up to 100%, but the reality is this is probably a full invested like 50 to 70% of my capital, with unallocated being in short-term treasuries, which is just for yield. It's unallocated cash, so I can at least get maybe a 3 to 4% yield on that cash if I'm not doing anything with it. But that's also there for dry powder. That is the, buy during the March and April correction, buy during our next 5, 10, 15% sell-off. If the markets get worse than that, great. I actually think if we see like a pretty healthy spike up on the VIX or a pullback that's meaningful in the double digits, then that's allocation. So the way I'm looking at as far as invested capital, probably a 50, 40, and 10. I might be able to split this and go more like 50, 30, 20 if I like Bitcoin enough, especially trading something like IBIT, which is I can have a position, I can take a collar trade, so I have upside and downside protection, or I can at least generate premium on the upside, lower my cost basis, but at least have downside protection. Or I can trade synthetics. And actually, the one thing I've been talking a lot more about in my daily sessions is, since I'm taking some profit, I closed out positions on GLD, SLV, CEF, PHYS, all today. And I have not wanted to do it. I wanted to just put in trailing stop losses, but here we are. If we take a look at our positions, let me delete this for a second. So if we take a look at where we are at right now on silver and gold. So gold is 39.56, creeping up on a 4,000 target on spot price gold. I have a feeling we can get there, but Kane, in all your years, I'd have to go do some I can probably prompt some chat GPT or something for this, but I don't know if we've had a run this extreme, because the last time if you see this on my chart, gold capitulation 30% from the dip. This number one bar count and number two percentage, we are 23% above the 200-day moving average, and we're also over 500 bars. The last time that this hit a 200-day moving average was back in October of 2023. So it's a long stretch, man. And this is from a wave count side. I've got to imagine this is a fifth wave move. If this is one, I'm trying to draw this out, but my drawing tool is being weird for some reason. So give me 1 second here. Let me go get rid of my drawing tool. I'll start this up again. Epic Pen, cancel. Okay, let me try this again. So this is, where are you at? There we go. All right, see if this will draw. Doesn't want, oh, there we go. Okay, so this is 1, 2, 3. And I'm being very generous here on this 3, saying this is a wave 3, this is our wave 4. So if we are finishing a fifth wave completion on gold, and I'm not an LA wave person, I don't claim to be, but if I can see a pretty clean 3 or 5 waves, if this is a fifth wave completion, I know it can keep running higher, I know it can keep melting up a little bit, but we are due, especially with the bar count that I see, for at least a 3-wave correction or an ABC correction. I think 4,000 is a really interesting spot. I mean, gold is up over 40%. I also think, does gold correlate with this? Do you think this is a move that actually offers a correction in gold? If dollar goes up, does gold go down? Are you bearish on the dollar? Yeah, I guess that's my question. Are you bearish on the dollar?
I'm
short term.
I'm bearish on term. Yeah. Short, medium term, definitely bearish on dollar. Yeah.
Okay. Do you see the dollar just making fresh lows before we have a pullback? I mean, I came from the land of currency trading, where usually we see some type of flat pattern where the market can do, flush down, something like this, where the market pulls back and then we get the continuation. I would think that if we do make a slightly lower low in the dollar, I think it's going to build into some type of wedge that, I don't know. I just think it's too crowded. It's the worst dollar performance in 40 years. And if that continues to go lower, then I mean, not that it's a bad thing, because if the dollar goes lower, it's honestly great for the global economy. I think the downside is this is just continue to confirm the debasement trade. And I've got some charts on that right here, which I think might be interesting for today's session. Here is the debasement trade according to JP Morgan. Soaring asset prices, falling purchasing power. If you can see this chart, this is from basically COVID. Gold is up 148. I mean, this is the leading asset. Is gold over S&P, 148% over 106%. U.S. home prices up 52%. CPI cumulative inflation 25%. Purchasing power is down 20%. This is why Main Street feels it. This is why everyone's so this is why sentiment I think is so bad, is because people aren't happy, right?
Yeah.
You're losing 20% purchasing power the last 5 years, and you've got nothing to show for it. If you're not benefiting from being invested in these markets that are just up crazy amounts since 2020, it does feel like you're getting further and further behind. S&P has collapsed 80% in terms of Bitcoin since COVID, which I think is interesting. S&P is down 13% in terms of gold since 2020. So basically, if you have gold, if you have Bitcoin, they have outpaced, as far as appreciation, they've outpaced the S&P, which
Yeah, and
doesn't
just
feel
real
like a
quick,
bad thing.
does everyone, the audience over here, do you guys understand what a debasement trade is? Do you understand what these charts are showing? Just want to make sure we're all on the same page.
Yeah, we'll get some Y's and yeses in the
Yes.
chat here. So let's unfold this. Let's unpackage this a little bit. So
Yeah, we've got a few
this
no's
is
actually.
why, this is why my thoughts on the allocation need to be, okay, look, we clearly have some performing assets. I mean, I certainly want to trade things that are liquid, things I can be active around. If I just did 50%, equities and some gold, silver, Bitcoin, what that does is that allows me to participate in this and in this, and this loss of purchasing power can be made up for with or appreciating assets. So even though my dollar amount, my home can go up in value. It would cost more money to buy a home now in 2025 than it did 5 years ago. But if I'm selling my home now at double what I paid for it, I'm now going out to buy a home that costs double what it cost, 5 years ago. So everyone is selling high and buying high. Certainly with interest rates, it's a lot worse, at least for now.
Yeah,
So
so there we did get quite a few no's on that debasement
okay,
trade. So do
yeah,
you want to explain it?
Let's unpackage it. Yeah, let's go.
Yeah, all right. So debasement is the idea that your currency is worth, or anything, whatever asset that you're looking at is worth less and less and less. In the case of the US dollar, it buys less. So it's another way of looking at inflation, except it's not just inflation simply because the government is printing a whole bunch of dollars or a whole bunch of their currency. It's actually because of relative to those dollars or whatever currency you're talking about, other assets are really moving. So sometimes they're really moving because of something inherent inside of them, and sometimes they're moving simply because the asset you're comparing to there is a negative sentiment about that. And so that is getting worse. And so that's why, and that's what's happening right here. That actually both things are happening right here at the US dollar at the same time. So
Yeah.
so the amount of gold, for example, that you get for your dollar is much less than what you got 10 or 20 years ago.
Right.
And so it's a kind of very similar idea as inflation, except it encompasses more than simply the government printing a whole bunch more money.
Right. And on top of that, if you take the loss of purchasing power in addition to the running persistently
There you
higher
go. Yeah.
inflation, it's like this is why everyone feels how bad it is. When you've seen, we're being told that inflation is less than 3%, but if you go back to 2020, we've been basically annualizing about 4 to 5% inflation across the board. Now, I do think that inflation is, from the peak at 9+% going down, but I think the concern is where people feel it the most is every day at the grocery store, every day at the gas pump. I mean, my fiance was out of town last week in New York, and so just a little evening stroll is like take our son, he's 8 months old, take him to the grocery store, just kind of let him look around and soak it all in, but just like pick up a couple odds and ends, pick up some snacks, pick up some stuff for the week. There wasn't a single day that I walked out of there with more than like 1 or 2 bags of stuff. It was at least $100, and it's like we're talking about like baby food and a couple of snacks for like the couple of days, and it's like every day was like 125 bucks. I know it's not every grocery store. Obviously I can shop at Aldi's, I can shop at Walmart. I don't like Whole Foods. I mean, anyway, point is, I think everyone knows, like you go into a grocery store, you go into a retailer, anything that you're looking at on the shelf, it's like, it's expensive. Kane, how old are you? Were you about the same age?
I'm probably older than you, actually. I'm 45.
Okay, I'm 43. Do you remember this? This is an old school toy, but do you remember My Pet Monster?
Yeah.
Do
Yep.
you?
I
Okay.
do. I do.
So
Yeah.
my nephews, I have a 20-year-old and a 17-year-old nephew, and when they were kids, I bought them a My Pet Monster on eBay for like, I had it as a kid growing up, and I thought it was a fun toy, and I was like wrestling on the trampoline and stuff like that. I think I bought it for like $50 on eBay. I can't find it anywhere online for less than $200 now. And so I'm
No.
like, I'm like, either this is, I get nostalgia is like deep. It runs deep into like, maybe people our age, but it's also like, is this rewarding hoarders for just having stuff around the house so they can just throw on eBay? It's like, it's stuff I've never gotten rid of, but I'm going to go ahead and charge. I mean, GI Joes are hundreds of dollars. But anyway, this My Pet Monster is like, I want to get it because my son is like 8, 9 months, and give him something to play around with in his little playpen and stuff. But I'm like, $200, $250. It's like $400 if you want the fancy cuffs that come with it. I'm like, this is insane right now. So anyway, you got to draw the line somewhere. But I just think that this screenshot, this is why it feels like people are falling behind. If you're not participating in what is appreciating, you have your dollar going way less farther. Or I guess I get your dollar just gets you way less than what it used to, and you feel it. And then everything around you is more expensive. And plus, when you get CPI reports and it's like, well, we don't count food and energy. We call that core CPI. Well, we experience food and energy because we have to fill up our gas at the pumps, and we have to go buy groceries. And I don't care that egg prices are down 85%. I care that across the board, like everything is higher, right? We experienced shrinkflation where like little cans of soda. I mean, you buy a 20-ounce soda at the checkout aisle, it's like they're $3 for just like a one soda. It's just crazy, dude. So anyway, gold is great and silver is great. S&P is great, but the weird part is this all changes if we start to see any type of tightening or deleveraging the economy. And that's kind of my next segment is, do you see anything that would force the markets to go into some type of deleveraging? Would that have to be like earnings related? Are we talking, is it too concentrated? Is it too frothy right now? Or are we in just a totally new paradigm?
I think the biggest risk right now, as I see it, is actually the rate cuts. So
Rate
because
cuts.
this
Okay.
market has priced in so like with such high probability the rate
Yep.
cuts. Yeah, if you go to, but yeah, there you go. So if
Yep.
we do like one more rate cut is almost 95%
Yep.
baked in, and then
Yep.
two more rate cuts by the end of the year is 80. Was that 83? Is that the number? Yeah,
83 for December.
83.
Yep.
That is crazy. So
Yep.
if there's any sort of news that gives us any inkling that they might not actually cut, and one thing that might do that is if there's some sort of data that shows us, oh, hey, we need to worry about inflation now,
Yeah.
those numbers are going to start coming down. And if those
Very
numbers
true.
come down, then I think that's what breaks the bull run in the market.
Sure. Gosh, I mean, does the market care from like a 2.9 to 3% inflation? Like if we go from, I think headlines, what headline is 2.7. And also
Right.
are we even going to get the data? If we have a government shutdown that lasted this week, we might not see non-farm payroll on Friday, and the
That's right.
following
Yeah,
week, so not this week, but next week, we should have CPI and PPI. If we are still in a government shutdown for the next 1 to 2 weeks, we might not see that data either.
that's
And
right.
and I
Yeah.
think the market would actually care. It's like, okay, guys, this is now, that we're in full week of shutdown since the first, right? So since October 1st, it was officially the shutdown. Now it's the 6th. Nothing was resolved over the weekend. Betting markets are talking about a 15 to 20 plus day shutdown. What is the longest in history? Was it like 25 or 30 some days? Was like the
I think
longest
it
shutdown in
was
history?
30 to 35, I think it
Okay.
was. Yeah.
So and this is not like abnormal. We have had shutdowns in the past. We had some from what I pulled up, like the Carter administration to Reagan to Clinton to Obama to Trump. There were actually quite a few during Carter and Reagan. Obama was a one-time thing. Clinton had two during his presidency. Trump has had, this is I think the third or fourth shutdown under Trump since 2016's terms to now. I think this is the third or fourth with Trump. But I wonder with this window, it's like, are we going to come back to a government that is the early stages of Doge, where it's like, well, hey, look, while we had the shutdown, this department was gut and cutted. This department and these people were laid off, and maybe they don't come back. So, but as far as non-farm payroll this Friday, if we have it or if we don't have it, what happens when we actually do get a print? Because now people are discrediting every job print that we have. They're saying it's all fake news and you can't trust the numbers. And same thing with CPI. Nobody believes it anyway. So
Yep.
it's just this weird environment where the market is blinders on. It's interesting that you say, it's all about this Fed cycle. I mean, I think it is the Fed at not taking like the jumbo cut. We're not doing 50 basis points. I think they're still going to cut the labor market by the end of the year. Kane, do you think that we're going to be up from 4.3 unemployment to like 4.5, 4.6? Do you think we're going to see like an uptick in unemployment? And if the market will actually take notice?
Definitely possible. Yeah.
Okay.
I don't think it's I don't think it's an unlikely event. No.
Yeah. And also this is where, I mean, if you've been watching this watch tool, we had at one point, the market was anticipating 6 cuts. Well, now this is 2, this is 3, this is 4. All this is just a huge question mark for maybe the 5th rate cut, right?
Yeah.
So we could have 5 or 6 total, but it's like from basically July of next year to all of 2027, nobody knows what's going to happen with the Fed, right? And I don't even know who the next chair is going to be. I know that Powell's probably going to serve out his term, whether that's March or May when he's done in 2026. Is it Stephen Marin? He was like the one outlier dissenter where he's calling for like 5 immediate cuts, and that's I don't know if people look at that as like, well, that's just never going to happen. Well, it might. I mean, I don't know, man, but a 94 to 84% probability for these next couple months. This is while the labor market is experiencing a low hire and low fire environment, but it could get worse. Like we could have more workers in the federal government laid off. We could have people that, I mean, right now tech is cutting jobs. If you've seen this, Amazon is talking about laying people off. I think it was Accenture looking at laying people off, Amazon looking at laying people off. These are some of the biggest employers in the US, and they're talking about jobs being disrupted by AI. That's not nothing, but the Fed is cutting, and I don't think the Fed is cutting because of inflation. The Fed is now, they've been pushed into a corner. They're cutting because also I think they see the slower labor market. So I don't know, man. It just feels like we got to thread the needle. I can't believe the market's sitting here at all-time highs. We're having this conversation where it just persistently goes higher. So let me bring this back to this. On a day-to-day basis with your gamma level and your gamma, it's Gamma Pocket Pro. Is that what you have?
Yeah, well, we have the GX training terminal that gives all the gamma levels.
Yes.
That's the software that gives all the gamma levels. Yeah.
Okay. Do you have in that software? Do you have a what's kind of your typical like timeline? Like if you're taking a trade based on that information, are you going out like a couple of weeks? Are you going out a month, or what's your timeline of some of those trades?
Yeah, so I look at the overall picture first. Always start with the overall picture. What's the gamma environment that we're living in? You
want to show us, by the way? You want to show us?
Yeah. Let me do that. All right. Let's see. All right. So this is SPY. This is SPY, SPY. We don't have the indices loaded up in there yet.
Okay.
And so what we've got, this is the overall gamma, I think. Yeah, that's the overall gamma. So we see right now we're at about 670. We do see quite a bit of gamma up here at 675 and 680. So at least across all expirations, there is positioning with the 675, 680 strike. So the market is preparing for a bullishness inside of the markets, and that's going out. Like that's all the expirations. But of course, they'll be heavily weighted towards the nearer expirations just because gamma is higher at the money or closer to expiration, right? So the closer expirations are given bigger weight than further expirations. So this is already automatically kind of, it's designed for you to help you trade in the more immediate term as well. And then if we look over here, this is just this upcoming week. So if I change my expirations up to just the next 5, so that's today through Friday, then this is what the gamma picture looks like. You're probably a little easier to see here. When we no longer see that 680 super big, but we do see 675 in focus over here. So overall, the markets are still leaning bullish for this week and potentially hitting that 675 level by the end of the week.
Does that level at 655 actually matter? Since that, like, you look at that, the size of that, does that actually stick out a little bit as a potential like magnet? So we could possibly hit 675 and maybe if we roll over, like make a run to 660, 655.
Right. And so what I looked at over here is that zero gamma level and that max pain level. So basically the max pain level is at what price would most options expire worthless. So the max pain level is
Ah,
paid for the market, not for the market maker. That's actually
yeah.
good for the market maker.
Yep.
So if we roll over here and we go down, then the market maker, we go into a negative gamma territory. The
Okay.
market maker is hedging like crazy, and that it's going to drive prices downwards. So it will really depend. Yeah, if we tag that 675 and start heading lower, then that's got a 666 level,
Okay.
then we could see 655 start coming into focus.
Okay, let me see. So I'm curious if my levels line up with that. So one thing I've talked about day to day in my daily profit plan room is the positive and negative gamma pivot. So
There you go.
right now, if we're below like 670, I'm seeing this mostly from a zero DT lens, but below 670 on the SPY, that to me would be where we kind of roll over into negative gamma. So if we clear 670 to the downside, we take out last week's low around 668. That could easily open up to the downside. Now, it hasn't happened. We're clearly off of the sell off from Friday last week. We're right back up to the highs again. I want to ask you a question on the VIX. What do you make of the VIX right now, dude? I mean, we're sitting at like
Yeah.
16 plus VIX right now, and we're only
Hmm.
and what's been crazy to me is a plus 16 VIX on a day-to-day basis. I am super cautious because we're talking about like potential 1% moves on a VIX day, even though the market has been giving us like 0.3% to 0.5%. So it's been very
Yep.
tight price action despite the VIX being relatively elevated. Lows that we've seen this year have been low 14s. In the 16 pluses, it's like you're just right on the cusp of like some type of volatility type move, or it just resets like it did back in late September would be, I guess I'll show. Do you have anything on the VIX with your, yeah, if you just bring up the VIX right now. We had a
That's
big
it.
volatility expiration
Oops.
back on the 17th to 18th of September, and we were at like 1675 VIX all the way down to 14 and change. And then we just kind of persistently went higher, higher. So we're seeing like the VIX bubbling up, but yet the market is still making all-time highs.
Yeah.
It's a weird spot right now. I did put on a synthetic long on the VIX. I sold a put and I bought a call at 17. It was like I think a 281 debit or something like that. So my max risk is like $380 for, and I don't know if I'm going to get it, but it's out to the November expiration. So I'm giving us all this month into
Right.
November to see like if there is a weakness window. I'm hoping that the VIX can spike up enough meaningfully that I can grab a nice little hedge profit out of there. Um, but otherwise, this feels a lot like 2017. Outside, you have to ignore Liberation Day. You have to ignore like the
Right.
the February to March correction, February April correction. But since we had the bottom in April, this has felt an awful lot like every single week and every single month since April 9th was the bottom. That it is like 2017 all over again, and it's a lot like COVID. Once we had the big correction in COVID, it just continued to melt higher.
Right. Yeah. So that definitely VIX is giving me pause. That is another sign that I'm looking at that, hey, we might need to be a little bit cautious. Now, I don't know if that's by the end of this week or sometime next week. Just the fact that we keep hitting all these all-time highs. We had that government shutdown that the
Mhm.
market didn't even blink at, but we got this going on right there in the short term
Right,
on the
right.
VIX,
Yep.
and it's just I don't know. And then over here, if you want to call it that, if we want to look that short term, then that's just wedging upwards. And definitely, I there are a few sectors that look very, very toppy to me. And
Sure.
if those sectors start coming up, for example, semiconductors looks super toppy,
Okay.
and same with quantum computing looks very top heavy.
Yep.
So those two, and those are major tech areas. And if
Yep.
those start slipping, then QQQ, then SPY, all of those start coming down. So I think a hedge out to November is super smart.
And well, as I put it on, I'm like, is this far enough? Am I going out far
Right? Yeah,
enough?
yeah, yeah,
It's like,
yeah,
should I be out
yeah.
to like April or May just because I feel like if we don't get anything by the end of this year, it's like, well, it's just a wasted $380, but hopefully that yields, additional all-time highs. And, this year, I think I've had, look, I had a great hedge going into Q1. February, March did really well. April, of course, I was riding some pretty big hedges to the downside. I survived the 20% peak to trough pretty well, came out of the right side of it, aggressively sold premium into it. And, a lot of those expirations for me were into June, July, August. And then now a lot of my expirations, Kane, are out into the end of the year. I think that as long as I'm positioning for forgiveness, where I can give myself, like today, I took a trade for my Project Options Edge. I did a ratio spread on Tesla out to June of 2026. and I went all the way
Wow.
down to the 230. You can bring up the Tesla chart here.
Yep.
So I bought a 230 put, and then I sold the 220 put with two contracts to create a ratio spread, and I collected $6.20. So Tesla would have to drop over 50% for me to not win on this trade.
That's crazy.
And I think it's a pretty good trade. Granted, I'm going out in time, but I think Tesla, after getting through Doge and the back and forth between Trump and Musk there for what, 2 weeks, where they had it out in public on Twitter X and whatever other socials, then all of a sudden it's like you don't hear anything about the American Party. You don't think that nothing's going on between the two of them now. We've got EV credits are maybe ending at some point in the end of 2025, I think. But anyway, point is, now everything for Tesla is, if you believe in robotics or autonomous vehicles or an energy play or an AI play or chips to compete with NVIDIA, I would put Tesla in the same category as it's not a car maker. It's not just a car maker. I think investors that are long Tesla know that, or at least are trying to express that. And that's been my way of playing Tesla too. Is like, I have to believe it's more than an automaker. That's why I'm trading it. If I loved automakers, then I'd be in Ford and GM, in Stellantis, and I'm not. I hate automakers. I think Ford has been dead capital for me for a couple of years. I still have shares of it. I get a 4% dividend. It doesn't go anywhere. It's a $12 stock. But Tesla has been crazy, and this little breakout since 340, 350, all the way up to 4 and change has been a huge run, and we're not that far away from all-time highs. So I think it's a good trade. I mean, I'm giving myself also 50% buffer, and I know it's a volatile stock, but I think it's a pretty safe income trade. And I've also been rolling calls on the shares that I did own when I bought it back in April. So far so good. But
So Mary, he went out to June of 2026 is what he said.
correct.
Is that correct?
Yep. It's like 255 days is the expiration. So I posted that officially in my Project Options Edge today. There's about an 88%. I'm looking at the current option chain, 88% chance of profit, about a 6% chance of assignment. I will own the shares. I'm willing to own the shares. And my break-even price would be, if I was assigned at 220, I have a $10 buffer, plus I collected 620. My break-even price would be, and Kane can bring this up on his chart, 203.80. So if you just,
203.
that's my break-even. So if I own shares of Tesla, I would own my first chunk of shares at 203.80. First thing I would do is just sell a covered call. And if I wanted to make it an income trade, I sell a 205, I sell a 210, and I try to repair it for, maybe a $500 to $1,000 type move. And, if you have a cash account, it's not cheap. It's a $21,000 position, but if I can flip it for $1,000, that's pretty good. What I've done a lot on Tesla this year has been, when we had this run from the 350 to 400 plus, all my calls now are in the money. So I have like a 350 call, a 340 call. Those are all in the money. And I'm missing out on the upside, but I'm also rolling it every like 30 to 45 days, and I'm pulling in an extra like $3 to $5. So it's now just become an income trade for me. And then trades like that with the ratio spread, I like it. It's way out of the way. I think it's safe, at least for me. I mean, it's a lot of money to put up if you have a cash account, but I did it in all of my margin accounts, just because I think it's a nice little income trade. So anyway, on the semiconductor side, do you like anything over another, like SMH versus SOXX or SMHX? Do you trade any of those?
I follow SMH the most.
SMH the most? Okay.
Yeah.
Okay. SMH, so SMHX. I'm going to do some more digging into this one, but this is like fabless semiconductors. I think that I'm trying to pivot more around. I don't think that the trade is just all about chips. I feel like we have to have more into the hardware stuff. Like, you've got to have the gaskets and the bolts and the nuts and the components and stuff that make up for, like, how are we building out these data centers? What are the actual pieces that go into this? And also, I'm long utilities, I'm long energy, I'm long industrials. I'm trying to take kind of the boring approach to benefit from AI as like a peripheral trade versus chasing the alpha that has been. I feel like I'm too far behind it right now. I feel like I've already got a late start to being long semiconductors outside of buying the dip in April. I mean, if we get a pullback, I wouldn't mind throwing some SMH in. If we get a pullback to, I mean, you've got the chart up here, but if we pull back to like 290, 280, I might take a stab at it. But I could see us also pulling back 50%, Kane. I mean, it's volatile enough. What would be a 50% pullback from the April lows? That would be 260 or so, give or take.
50% from current levels or?
No, if we go from the April low to these
Oh,
current
April.
highs, yeah, that would put us around
Gotcha.
like 260 for a pullback. And again, I don't
Okay.
think we pull back that far, but if we did, it's like, well, there's a great equilibrium
Yeah.
trade I can start establishing new positions on because I feel like I'd be chasing everything at highs, which I don't want to do.
Right. So Chris is saying that was about 94%. So if I go to
Correct.
47%, that would be, yeah, it's about 260, 265.
Yep.
Yep.
So that the stock market doesn't necessarily give us equilibrium, right? Futures market
Right.
more so, forex more so, but like big levels to watch and retracements with stocks, indexes would be a 23% pullback, 30% pullbacks, 38% pullbacks. Those are way more common. It's difficult to get like the 5 O's and the 618s if you like those Fibonacci numbers. It's very tough to get those, or it's going to take longer to get back to those highs. But when the market only dips like 20 to 30%, it's like that reflexiveness of it just pulls back by the dip, pulls back by the dip. That's typically what you see on like an aggressive index. Is a 21 period moving average is very, very supportive, as we've seen since really like May of this year.
Yep.
So what are you doing in semiconductors? You got SMH. Do you have are you doing anything on them right now? Do you have any trades on that are currently positioned?
I'm actually, yeah, I am looking at shorts in the semiconductor just because
Okay.
basically I'm looking at the very weakest stocks inside the semiconductor space. I was pulling them up this morning. I do have a position in Synopsys. So
Okay.
that's under its MA 200, and if the SMH or if semiconductors just tank, Synopsys already being in a weak position, I'm expecting it to fall even harder than SMH. So if SMH just pulls back to its MA 20 or
Yeah.
EMA 21, then whatever. But Synopsys could come and retest these lows right here in
Okay.
that case. And then I'm also earlier this morning I was taking a look at TXN, not looking the strongest right here. Just
Okay.
got pulled back below its MA 200, came up and retested it, and then just been kind of going sideways for the last week. And then the other one was POWI. That's definitely trending downwards. Okay, power integrations. So
Oh yeah.
that's looking very weak right there. This is probably my top pick if I were to go into one right now. And I
Okay.
had VLN as well. No, forget VLN.
Okay.
POWI. Yep.
Okay. I'm gonna look at TXN. Actually looked good enough that maybe I'm gonna pop this in my pinch point scanner and see if
Yeah.
we got to get set. We're almost there. We almost have a nice little go filter on TXN. So you take a
You
look at that
wanna
one.
you wanna share your screen or?
I'll grab the screen here. Sure.
Yeah.
So what I'm doing is if I go into my pinch point scanner for all and I can type in TXN, I just looked at the chart that Kane had up and the way that thing is coiled and kind of pinched together. It's a nice range trade. So if I go to TXN, we're looking for a breakdown. So that goes right along with what Kane is saying. And the get set, I mean, the stock overall has been sideways for long enough that this energy I think has to go somewhere else. So let's go to a slightly higher time frame here. I mean, for the last I mean, it's almost 4 weeks of consolidation.
Yep.
We're supported off of the 200-day moving average on the weekly, but obviously during this year's correction, we came down lower. If you go to the daily time frame, we've got everything stacked to the downside. So unless this price is going to get back above like 190, I would say that the momentum is we're making lower highs, lower lows. If we clear this 174, we can certainly chew back into these other levels. Let me actually price this one out really quickly. So if we go TXN. What's the expected move out for maybe the end of the year? Can look at a swing trade. So December is 74 days, January is 102, plus or minus $21 to $25. That's I think we'd have some volatility there. So the good thing is we're going to have some movement. The bad thing is my strikes are 5 wide, so I don't have the precision that I'd love to have. But maybe I can go. We're 182, so it's kind of right in between my strikes. If I went like $15 out of the money, maybe doing like the 190 by 195. That's cheap-ish. I look at this maybe going both ways. So let's go $15. So that's down to 170. So that's 342 to make 5. If I did another, so 630 to make 10, I'd probably have to go one strike out of the money again. So now it's 288 to make 5. That's still a little bit pricier than I want it to be. Sucks. I was hoping I could get like if I can risk 250 to make 250, I kind of like the trade a little bit better.
Yeah.
Like I said, the challenge here is that the strikes are $5 wide, and if I go $20, it's going to put me at like I need like a $200 strike. And if I go 200, then I go from 2 to 210. That just puts me
Ooh,
a little
yeah.
bit further than I want to be, right? Like 200 by 210, I'm right at the edge of the expected move. And now let's go. That would be $20. Let's just go down to 160. So if I went 10 wide, 10 wide, I pay 423 to make 10. However, I'm right at the outside of the expected move. If we do move $24, let's do the math. So we have 182 as a current price. 182 plus 24 puts me up to 206. Well, Kane, that doesn't really cover the cost of my
Right.
trade, right? It like
Yeah.
gives me a break even trade. If we go to the
Yeah.
downside, 182 minus 24, 158, it barely covers my put side. So it just doesn't price out to be the trade that I'd like. If it was a directional trade like you're taking to the downside, there's a lot of ways to get some asymmetry built into that.
Yep.
I kind of like maybe like the 185 by 175, pay 477 to make 10. If price goes down like you think, you could probably manage some partial profits within that $5.23 profit target.
Right.
So
So
I like that better if you
Maggie
like the
was
direction.
asking, yeah, for the directional trade. So Maggie, what Chris just explained was a very good way to take advantage of a directional movement downwards. And then Baja Pete was pointing out that there's earnings on October 21st. You want to explain to him why you care or you don't care about that on the condor that you're showing?
Well, the reason I wouldn't care if I went out to January or December, I don't really care about earnings because that's just a catalyst to continue to drive price. So I
Yeah.
don't really care because I'm out far enough that I'm not really playing it based on earnings. I mean, earnings is a coin flip up or down. I can tell you what roughly earnings should be based on what we have for earnings. TXN. So let's go out to. So the average earnings move is about 8.6%. Let's see if we. So this is in October, right? The upcoming earnings is October 21st. So that's only a couple weeks out. Average move is about 8.6%. So we'll go 866 times the current price, which is 182, 182.33. So we'll go times 182.33. So from what I see, the earnings move is probably a $15 to $16 move, plus or minus. So plus or minus $16. The broker, and I've noticed this too. This has been pointed out in a couple of my other sessions when traders have Thinkorswim versus Tasty Trade. Tasty Trades plus or minus is oftentimes a little bit less than Thinkorswim, and I don't know who's right or who's wrong. I trade a lot of accounts here with Tasty, so I take that math for what it is. But let's see what it is. So based on earnings here, the 21st, my nearest expiration would be the 24th. That shows a plus minus 13.55. I'm showing historically the average move on earnings is about a $15 to $16 move. So earnings should be something slightly ahead or greater than what the market makers are showing right now, or at least the implied move of 13.55. So earnings would be a good catalyst to start driving price one way or the other. Kane, I think if you're right on your direction to the downside, this is what I could certainly see happening. Gap up into resistance and then selling off in the direction that you're continuing to go, or
Yep.
gap down, right? We gap down and gap lower, and then we possibly fill that gap later. And the plus or minus $15, $16 is maybe something in between. One thing I'll look at here is how often does TXN hit 8.6%? That's what I want to see. If we went out towards an earnings move, let's go post earnings. I usually give my earnings trades up to 13 days. So what I'm going to do is just look and see how many times. So from 1 day to 13 days, how many times do we at least have to have eight? That's not drawn very well. 8.66. So 8.66%, which means if we hit it, so if we have yeses and nos, how many times do we hit 8.6%? If we hit it more often than not, that means that going long directionally would have a probability of paying us. If it's not hitting our expected move, then selling options, i.e. kind of calling the top or calling the bottom, would be better suited. So price is within that kind of contained plus or minus level. Does that make sense, everybody? Can you get on that? Did I explain it okay?
Makes sense to me.
Okay.
Yep.
Okay. So how many times do we at least hit 8%? So this first one here, that's a check. This one is not. This one hits 9.9, so that is. This one is not. This one is 8.6. It's right there, but technically 8.66, and that's the final day. That's a no. This one gets there the final 13th day. That's a yes, but I hate that trade when it's the expected move the day of expiration. That's no fun.
Yep.
This one is 8.86, again, the final day. That's what this also tells me too is how long should I go out of if I'm trading earnings, how long should I go out? Maybe this is better off to do like a 30-day trade versus like a 13 to 20-day trade. But let's keep going here. So let's go. That's a no. 7.3, 9.2. Man, they like to hit it on that 13th day. That's pretty amazing. There's a no. There's a no. There's a no. There's a big yes. There's a no. So I'm counting. It's probably going to be more of a coin flip. There might be a slight edge one way or the other. But this is what I kind of go through for my pricing out of earnings. This one is also a no. That's a no. That's a no. That's a no. A lot of these are pretty boring. Under that 8% average. This one finally got there on day 8. I'll just do the bottom 3 here. This one, nope. And this one, 8.38, not quite. This one again, not quite. So I've got a lot of no's here, Kane. We have 1, 2, 3, 4, 5, 6. We have 7 yeses. So 7 times it hits the expected move within 13 days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 times a no. So if I were to place this based on what this stock does most of the time during earnings, it doesn't hit the expected move. So a couple ways to play that. I'll ask you, Kane, if you had this information, is there something you'd like to do with it? Is there something actionable that you can see yourself doing on TXN by just this information?
Sure. Yeah. I mean, the simplest, like the lowest hanging fruit is a simple iron condor.
Yeah.
For them.
With an iron condor, do you accept, like, let's say we look at it right now and we do an iron condor, would you accept the credit that it's offering right now? Or would you like to go allow price to move to the upside or downside and maybe get a better fill on the iron condor?
Yeah, this far out from earnings, I would be waiting for, like, I'd do one side at a time. I'd leg into it.
Okay, that makes sense. That's cool. I like that. So this is the trade for me. Like, I would put this on the radar as, okay, we have earnings coming up on the 21st. So look at that on the calendar. The 21st is it's 2 weeks from Tuesday. So we have tomorrow the 7th is 2 weeks out from there. So coming into either the 17th on a Friday or coming in on that Monday morning, the 20th, then look to see where price is at and call that your center level. And that way it's all about earnings. Because if we do it right now, there's either price could like drift up or drift down, and you're going to be essentially like kind of biased going into earnings as we have that news on the 21st. So right. I like to take this trade a lot closer to earnings. So I mean, obviously, what's nice is let's come back and revisit this one on the 10/20. I'm going to revisit this trade on 10/20 and see if we can find a trade for it. Yeah, but I'll remember that the probability is a sell. And one thing I would look at is let's just go up to the expected move. Let's go TXN. The earnings print would be the 21st. We have that Friday, maybe going out to the 24th or the 31st expiration. So right now, again, I don't love this either. This is 5 wide. We have a $15 move expected, and that's going out right through earnings, like a week and a half through earnings. If I were to do we've got a plus or minus based on my calculations around $16. So if I did that, that put us up to about 198. So if I did like the 200 by 205, I get 81 cents for a 5 wide. That's not where I would take this trade. If this one was good for $1.66, I'd be willing to take that trade. If this one on the put side, if we go down to, let's see, 168 or so, I'll go 165. So if I could get filled in this trade, I guess either direction. It's like if I got filled on one of them for $1.66 or the other one for $1.66, I'm willing to take that trade where I'm risking $3.34 to make $1.66, and I can, protect some profit on one side or the other. So that'd be letting price kind of come to me, letting price kind of drift one or the other. But if we revisit this trade on the 20th, one thing we could do during earnings is if I were to sell, let's say we're trading right around 185, Kane, I'll just sell the 180, sell the 185, or sell both legs, and then I'll go up like 20 points. So let's go like 85 to 205, and then go down to 165. Yeah. So the broker is giving me like a $13 credit. And that means that if price moves less than $13, I can turn this trade into a winner. I'm risking $700 to make $12.89. This also is a good one where like the day after earnings, we usually see a pretty big volatility crush. And if price has
Yep.
gone next to nowhere after earnings, usually this like $13 credit could be trading for like 12, 11, $10.
Yep.
And that gives me a pretty quick win. So there's
Yeah.
a lot of ways to tackle this stuff.
Yeah, and what Chris just set up there was almost like a butterfly. It's like very close to being a butterfly.
Mm-hmm.
So that offers a really good reward risk ratio. So I think we'll have a couple minutes left. We're pushing up on an hour here. So
Yeah.
there's one thing real fast that to go back, circle back to when you originally did a January expiration, and I think I forgot who commented about the earnings that were coming up. Well, Chris doesn't care so much about that because the earnings event is so far away from his expiration. And
Correct.
if you looked at the implied volatility, the range, the expected move range, it already took into account the earnings. So
Yep.
when he built his Iron Condor, he already took that into account. That so January, I think it said 24-ish point move, and so that
Exactly.
already accounts for that 15 or 16 from earnings. So
Yep.
is there anything real quick before folks leave it? Is there like a trade that you're just itching to get on right now, something that you really like right now at the beginning of this week on a Monday?
Well, I will say, so I took profit on GLD, I took profit on SLV, I took profit on PHYS, CEF. Those are all my gold and silver positions. So what
Yep.
I'm looking to
So
do right
Jeffrey, pay
now,
attention there. He was asking about gold, silver.
yep.
What he
So
should do with
look,
his positions. Yep.
what I would like to do on gold is I think what I'm going to do is, so here's what I do have. If anybody's interested, this is a set it and forget it right now. I have basically every moving average, the 21, the 50, the 100, and the 200. I'm skipping the 144, but every moving average that I have on the daily time frame, I have a $1,000 allocation. So 1,000, 1,000, 1,000, 1,000. And I'm doing that because I get that gold might surprise us to the upside, but we're going to have a pullback, Kane. Eventually, we're going to have a pullback. And
Sure.
I don't want us to be shocked to literally see like a 15 to 20% correction in gold and silver. I just think based on this bar count, based on this move, I think we get it. I don't know what the catalyst is. It may be that driver in the dollar, like I talked about. It could be something, we got a couple black swan talks, which nobody really knows what a black swan event would be. It's just, maybe it's this, but nobody really knows. I do think that the bond market is potentially the one big troubled point that if the market is going to see like a flash of risk, it could be in the bond market. It could be in
Yeah.
yields. It could be in actual
Mhm.
bonds. It could be this debasement trade that just gets exacerbated by like nobody wants treasuries. And I know that's not true. Like everyone's dumping US treasuries. That's not true. They've actually seen a lot of inflows since April. But I just think that right now it's like people want gold more. Central banks want gold more. Some of the stuff that's happening in comics right now and in London, New York, the need for like physical delivery is as high as it's ever been, and there's a huge lag time in actually getting physical delivery. And I just think gold and silver they're getting a lot of attention. But here's one thing I'm cautious of: everyone's talking about gold and silver now. Everyone,
Yeah.
everyone, right? I was just at a dealership this weekend, and somebody was asking me about Bitcoin, and somebody was asking me about gold. And when you've got clearly not traders is asking me about gold and Bitcoin, I tend to use that as like that's kind of
Yeah.
that first contrarian signal where it's like, okay, now if Main Street is talking about it, I'm a little bit less interested. And so I want to position for that correction. So anyway, trade that I'm giving is this. I want to have dollar cost average positions first and foremost. So if we get pullbacks, I get filled. I want to maintain an allocation in gold. One thing that we can talk about more, and we can save this for next week as well, Kane, but I am probably going to establish a synthetic position on GLD. It's going to look something like this. How far out can I go? I'm going to go to January of 2028 and go out really far. If I sell a 365 put and I buy a 365 call, right now that's going to cost me $2,200. Now that's the most I can risk is the debit. Okay. Now here's what I'm going to do. I'm going to cap the downside because selling a put means I have unlimited risk. So I will, to take this debit, it's going to be a little bit more pricey. But if I go 365, could we have like a crash in gold? Well, maybe I can take like a, 330. Let me go like 330 or go way out of the money here, Kane, to like a 299. But I
Mhm.
think what makes sense is if I'm going to pay this for debit, maybe going down to like 335. I pay a little bit more, but I cap my buying power and I cap my risk. And this allows me to get some type of put protection where if we have like a really aggressive crash, I still get the benefits of being long gold, but I also have a downside protection where this 1850 debit can possibly turn into, $25 credit, $30 credit if we have a big correction. In fact, I'll do this. Kane, let's say that we go to the $200, the 200 moving average. Are we good on time, by the way? Do you have to run right at 3 o'clock, or we go like 2 minutes longer?
I'm good going a little over.
Okay.
Yeah.
All right. All I have is my YouTube session. I'll merge into that in a little bit, like maybe 10 minutes or so. So if I looked at the 200 moving average gets hit, then we're going to say this thing can go down to $300. So if I take this 335, right now this 335 is trading for a 31 delta. So 0.31, and that would be a $35 move. Now 1085. So if I took this exact trade, I buy the 365 call, I sell the 365 put, that creates a synthetic long. If I buy the 335 put to go with it, what that's going to look like, it's going to cap my downside, but this can serve as a hedge if I'm willing to own shares of GLD, which personally I am. I'm willing to own shares of GLD. Now, 1085 is going to be what I could expect this to become. So 1845 debit can be added. 1845 debit. If I go ahead and set a take profit here, Kane, I can take this trade for $3,800 and set a take profit on the 335 put for $29.30. Now that would help me lower my cost basis from $38.47 down to about a take off about $11. So let's go $38.47 minus 11. Now I'm long this synthetic with a debit of $27.47. All I need gold to do is go up. And if gold continues to fall, then I can also sell calls against this long call. I can turn this into like a diagonal spread. So it's going to be kind of multi-layered, but this is a more cost-effective way. Look, man, I just took profit on GLD. I've been in this thing since 2022 and 2023. Once we had our pullback in 2022, I had a little position, little more. I have not bought more GLD since 2024. All I've been doing is selling puts and doing ratio spreads. I haven't bought a single share since literally 2024, which makes me feel like, oh man, I could have done more in gold, but I'm still trying to generate income on it with the position I had. So now that I've closed out my shares, I'm looking at establishing more of a cost-effective way to kind of own shares. I want to own shares, but I think the easiest way, if this whole idea of like synthetic stuff is, confusing, then look, what do you want to invest in gold? Okay. If I've got, let's say a $25,000 account, I've got 25K, and I'm willing to say, you know what? I'm going to put 5K. Okay. I'm going to put 5K into gold. So I put 1,000, 1,000, 1,000, 1,000, 1,000, and I don't worry about it. Because if we come down and find these levels, that to me is support. We work our way back up, and we're talking gold at all-time highs, which I think gold gets there. I think that this is going to be a really interesting 3, 4, 5 years, maybe the next decade, of how the debasement trade really takes shape. And I think gold can be a surprisingly fantastic asset for everyone to have in their portfolio. And I'm not a Peter Schiff. I'm not just peddling gold, obviously. I think that it's a trade where, look, literally gold has outperformed the S&P this year. It's outperformed the NASDAQ this year. That's not normal. But I almost think that I need to do some research on this, but does gold go sideways, Kane? Does gold have more than a 15, 20% correction? Am I overlooking something? Am I just getting too optimistic about gold? What do you think?
Well, I think there is a lot of good arguments for gold to keep on going up, but
Sure.
The risk manager in you always thinks about those things, right?
Yeah.
So, and what are the most cost-effective ways to get in? Like, do you just buy at those levels? Do you sell a put in order to get in at those levels? And all of those sorts of questions.
So I can dollar cost average in, or if I have the cash, I buy 100 shares, right? I'll buy 100 shares, and above that, I sell a call, and below that, I buy a put. This is my favorite way to protect any core position. I have the shares. I can get it called away if price appreciates, and I have downside protection in case the thing dumps. This is a collar trade. I do this all the time. And that way, if you have the ability to own at least 100 shares, selling a call above, buying a put below, you're protected to the downside while also getting some additional premium or also lowering your cost basis to let the shares get called away and the price going higher. The downside with a collar trade is obviously if price continues to rip to the upside, then you get it called away, you do it again. You get it called away, you do it again. And that's not bad at this point, Kane. Now that we're up at 45% at gold this year, it's like if I buy shares, it goes up another 3 to 5%, it gets called away. That's income. If it drops 15, 20%, that buy put, you are going to be so thankful that you had it on there because you can now go with the price of the decline. So anyway, I think let's unpack more of this. I'll do kind of a more simplified version of talking through some of these synthetics for next week. But hey, man, I think that was a lot to unpack in session 1 of Gamma Report. I'm looking forward to do this many more times. But again, everyone that's in the chat, give us some feedback. Kane, where can everyone contact you? What's the best way to get a hold of you?
Yeah, it's email me at kane@investpub.com. I'll type that in there.
Type it in the chat for everyone. Kane@investpub.com. I'll put my email in there as well. Mine's easy. It's chrispulverpub@gmail. I just created one just to make it easy so I can check Gmail on my phone. It's a lot easier than doing Outlook. So chrispulverpub@gmail. Look, there's a lot that can happen. But look, next week we come into our session for the Gamma Report next week. Kane, we have this week's FOMC minutes. Yep. I think we're going to have them. Unemployment claims on Thursday. I don't know if we're going to have them. Non-farm payroll. I don't know if we're going to have it. The following week is inflation data. So, I mean, another week of no U.S. news. I don't know if the market actually cares. I think that they should. But from a technical side, I'll ask you this. I feel like I've been a broken record for a while. But SPX 50-day moving average. Any thoughts on that as a test or a touch in these next like maybe 30 days or so? The 50-day moving average.
Yeah, I'd say 1 month plus. I'd put it in the realm of possibility. Yeah.
Okay.
We're so far away from it.
I know.
So deviated from it.
and it's not just it doesn't mean the market has to just turn to find it, but even if we went sideways, if we go okay, the market just kind of stalls here. It's enough to go sideways that it catches up. At least it acknowledges that it can be tested. But obviously the tough part is like it just blows through it. It gets further and further stretched, and then we have like that correction, and it just pulls back a little more violently. But I think that is a key level of support that right now, if we hold above the 21-day, every dip since literally, I mean, this April to May pullback, every dip has been bought on the 21-day moving average. Every dip. It is crazy bullish right now. So that 21 is pretty key. If we go sideways, watch that 21 period support. If we break below that 50 period is right there. I truly think this is a buy the dip market right now, Kane. I think that getting 20% year to date, hitting 7,000 round number is feasible. The JP Morgan collar trade has now been pushed out to December 31st with a lot of gamma flows at 7,000. So that matters. I think that's going to put a lot of positioning going towards that 7,000 handle. I think buying the dips, it's like, I don't know. I'm not saying it's a guarantee because it's certainly not, but it wouldn't surprise me if either we get dips and then we try to get to 7,000, or we just keep this silly little melt up going until we hit it. And then we have some maybe flat line into the end of the year. But, I don't have a crystal ball, neither do you, but I think this market is still a buy the dip right now. Fed's going to cut rates. We're spending money like we got it. Fiscal deficits at 6-7%. CapEx spending, it's just hundreds of billions of dollars being poured into this stuff. Look what happened today on AMD. I mean, it's like, but look at price action. It's like we had a 30+% gap higher and it's fading, but my gosh, man, it's like 37% out of nowhere. And it's like, I thought it was earnings today. Nope. It's just news. It's just news that they're doing something with OpenAI. And it's like, this is the frothiness of the market. So this is the stuff that I don't want to chase. Personally, I don't like to chase this stuff. Kane, I don't know about you, but this drives me crazy where I can't find this stuff on my own. So if you're lucky, if you've been in AMD long, it's like, that feels great. But this to me looks just like this. It looks like this. It looks like this move in Microsoft where it gapped up and faded. It looks like this move on Google where it gapped up and it faded. It looks like this move on Broadcom, AVGO, where it gaps up and it fades, right? It's like that type of move where it's like, I think we just have, that's probably pricing in a lot of good news right away. And it has to pull back and maybe, find some equilibrium. So I don't know. Just
I think you said it right about the buy the dip, right? Yeah. Forget about the breakout. Forget about these giant jumps. They do pull. They have been, as Chris showed you many examples of just now. They are pulling back, and then that pullback is a good time probably to buy, as long as the bullishness continues in the market.
Yep. And this market is quite bullish. Like I said, if you can't beat them, join them. That debasement trade, I think, is something just to keep in the back of your mind of like, what is performing well? If the dollar is going to continue to lose purchasing power, what performs well? Assets in the S&P, the NASDAQ, even if you're long Russell, if you're long the Dow, they're hitting all-time highs. Gold is up, silver's up, Bitcoin's up. Um, if you're, I mean, I don't like to chase the AI stuff. My AI play is truly being long Bitcoin and being long utilities and being long energy. That's like the boring way to trade it, in my opinion. Bitcoin's not so boring, but that's kind of my exposure. I'm not chasing individual AI related stocks because I feel like to do that, you're going to have, 20 picks out there. One could be good and 19 could be crap at some point. I just don't want to be stuck holding the bag on something that has no business being up where it is. So anyway, final thoughts, Kane. Take us home for this first installment of the Gamma Report.
Yeah, I would say, well, we are bullish for the week for now until it proves otherwise. And then, if we do get a pullback, we are looking at a pullback possibly back to the EMA 20, but that doesn't feel like this week. We could stall out this week, maybe chop a little bit of sideways, but that's what I'd be looking out for. So that's why I'm not super bullish. Overall bullish, but not super bullish. And just look out for those opportunities that where you can get those asymmetric returns.
Agree. A couple levels to note here for the week. This shaded green zone is last week's low to high weekly candle. One thing I'm watching very closely is today we kind of came up to test last week's highs. If we if we don't break this high, so we're very close to it, obviously, but if today's a test and a fail and we roll over a bit tomorrow, one thing I'd be watching for is, do we hit the high for the week or do we hit the low for the week? And maybe it's an inside candle week. Maybe it's in between here. But I do have a trade running in my waterfall income that we want to see price get back down below last week's candle. If it does that, great. If it doesn't, we'll take a loss on one of our positions. But I'm just watching to see there's a pretty good probability that if price goes higher and it breaks this high, then it's unlikely to come back to this low. So if you want to position bullish for the week, you can pretty much be bullish all the way into here and expect the markets to stay above last week's low. So that's a good way to think about it, especially if we take out the high. But I think right now postured higher. Kane had some gamma levels. You said 675 and 680 were the directional pushes this week on SPY.
675 more so.
675.
680 was overall one. Yeah, a little bit more of a stretch for this week. Yeah.
And 675 is not even 1%. So we're talking,
it's not far away.
Yeah, half of 1% away. We can certainly get there. Keep a close eye on the VIX. It's a weird VIX right now. Kane, you pointed out that really good. We're kind of making higher lows, equal highs, just something to be aware of in case the VIX does that. If it breaks higher, then we probably turn over a little bit. But obviously the market can do this as well and go nowhere. And the VIX just continue to offer vol suppression. But just like I said, be ready to buy the dip. If you have some dry powder, that's probably the best thing right now is have some cash in the sideline that's ready to invest. Dips are good. I think dips are good. The trajectory, the eagerness to buy the dips, the willingness to participate in this bull market. And I don't think it necessarily changes a lot. My big picture, I'll leave you with this. Big picture to me is we don't really have a lot of disruption to this current trend unless something bad happens in the bond market or something happens with the midterm elections. That's a long ways away. Inflation maybe, Fed, it's pretty much telegraphed what they're going to do. Trump and company, the administration is telling us what they're going to do, and they're trying to do it. I don't love declaring national emergencies and things. Like if we all of a sudden issue stimulus checks next year to households because people are falling behind, I feel like that can't be good for inflation. I don't know how we do that actually without having potentially like stoking inflation again, or I don't know. We'll cross that bridge when we have to. But anyway, man, Kane, this was a great Monday. I'm happy to do this like every week. I'm looking forward to seeing this every week and talking shop. So. Yeah,
I am too.
Cool. All right, everybody. Reach out to Kane. Reach out to me. We'll see you in these future sessions. But until then, happy trading, lots of profits. See you soon.
Bye, guys. Have a great day.